Welcome to Under the Hood, a video about how exchange-traded funds, or ETFs, work and why they are a compelling investment choice. We'll explore the precision engineering behind modern portfolios, emphasizing transparency and modularity. An ETF acts as a wrapper, combining the protective diversification of a mutual fund with the agility of an individual stock. Mutual funds offer built-in diversification, while stocks provide intraday tradability and liquidity. The ETF brings both of these features together. Let's look at the anatomy of the ETF basket. When you buy a single ticker symbol, you are purchasing an ETF share. This share provides proportional exposure to anywhere from 50 to over 10,000 individual companies across different sectors like technology, healthcare, and financials. The fund holds a specific and transparent basket of underlying securities. ETFs operate through a two-market microstructure, the primary and the secondary market. The primary market is the exclusive wholesale market, where ETF shares are created and redeemed. The secondary market is where over 90% of trading occurs, with investors buying and selling existing shares on the exchange. The Authorized Participant, or AP, is key. APs are large institutional investors or market makers, with the exclusive right to interact directly with the ETF issuer. They manage the supply of shares, capturing risk-free arbitrage profits, which keeps the ETF running smoothly. The secret sauce of ETF creation involves an in-kind transfer, meaning no cash is exchanged within the fund. The AP assembles the exact recipe of underlying stocks, delivers this basket to the ETF issuer, and in return receives a newly minted block of ETF shares. Redemption also utilizes the in-kind transfer. The AP recalls a block of ETF shares from the secondary market, surrenders them to the ETF issuer, and the issuer dismantles the shares, handing the AP the underlying basket of stocks. The fund is never forced to sell its holdings for cash. The arbitrage engine keeps the ETF price aligned with its net asset value, or NAV, which is the mathematical value of the underlying stocks. The AP's profit-seeking behavior expands and contracts the share supply, keeping the market price tethered to the true underlying value. A major flaw in mutual funds is cash redemptions. When an investor sells shares, the fund manager often must sell appreciated underlying stocks to raise cash. This triggers capital gains taxes, which, by law, are distributed to all remaining shareholders. In 2024, nearly 65% of equity mutual funds distributed capital gains. The ETF advantage is tax efficiency. Because redemptions are handled in kind, the fund manager never executes a cash sale. The ETF passes the lowest basis stocks out to the AP, pushing the taxable event out of the fund and protecting remaining shareholders. Consequently, only 5.08% of equity ETFs distributed capital gains in 2024. Advanced plumbing, such as the heartbeat trade, is a tax management tactic. ETF managers partner with APs to execute rapid, massive in-kind creations and redemptions. The goal is to intentionally flush highly appreciated stocks out and replace them, virtually eliminating embedded capital gains for long-term holders. ETFs offer a significant cost advantage. Their median expense ratio is 0.56% compared to 0.90% for mutual funds. ETFs eliminate 12b-1 marketing and distribution fees, and because trading happens on the exchange, they benefit from lower transfer costs and administrative efficiency. Comparing the two, ETFs offer continuous intraday pricing and daily holdings disclosure, while mutual funds price once daily and disclose quarterly. ETFs have high tax efficiency due to in-kind redemptions. They also have lower cost structures, eliminating 12b-1 fees, and require only the price of one share to invest. Intraday tradability is a key differentiator. ETFs offer real-time pricing, so you know exactly what you are paying at the moment of execution. Mutual funds are forward-priced. You place an order, but the price is determined only after the market closes. Understanding market mechanics involves bids, asks, and the spread. The spread, the difference between the lower bid and the higher ask, is the hidden transaction cost. The liquidity of an ETF is tied to its underlying assets. If it holds highly liquid stocks, market makers keep the spread razor thin. When executing an ETF trade, you can prioritize speed with a market order, which buys immediately at the current ask price but is vulnerable to sudden price spikes. Alternatively, you can prioritize price control with a limit order, which buys only at your specified price or better. The Boglehead core philosophy is about buying the haystack. Active investing is often negative sum after fees. The most reliable wealth engine captures total global market returns. A single global equity ETF can provide exposure to over 10,000 global stocks, eliminating idiosyncratic stock risk at a very low expense ratio. Beyond the core, factor investing uses rules-based algorithms to screen for specific characteristics that historically drive excess returns. These factors include value, quality, momentum, size, and minimum volatility. This delivers active-like strategies at passive-like ETF prices. Strategic asset location involves using tax-efficient ETFs for taxable accounts, benefiting from the structural tax efficiency of in-kind redemptions. For tax-advantaged accounts, like IRAs, it's optimal to hold actively managed mutual funds, taxable bonds, and REITs to absorb capital gains distributions and income yield. The ETF engine is the ultimate wealth engine, powered by low fees, tax efficiency, and broad diversification. The result is long-term financial autonomy, ensuring the maximum possible amount of capital remains invested and compounds, uninterrupted, toward financial independence.